I think this week made a good bit of sense, and I'm happy that the Risk Radar did a pretty good job in deploying its framework of a risky rotation, basically, over the last week. You kind of have to view the entire story here going back to inflation last week, this week, very much a continuation of that, given that was a second half event last week that set the tone for this one. It was still up for grabs whether or not rotation was going to be good for the market. I've argued that it probably won't be, just because the math doesn't really add up, but also because the underlying fundamentals of pivoting into economically sensitive stuff when the economy is very much in question, that doesn't really make sense logically. So it was a math argument, it was kind of a logic argument. I flipped the red light on the stocks yesterday looking for a more high correlation move to the downside. I think fair enough to say we got something like that. It wasn't a deep sell-off, but it was 9 of 11 sectors, it was 4 indexes, especially by recent standards. That was pretty high correlation. But it started yesterday afternoon too. So to see the market move more in unison than it has in weeks, I think tells us that there is some conviction building in the narrative. And it's been so mixed up that having, I think, to reset in a negative way was the thing that made the most sense. Everything else generally looks pretty good. I'm kind of tempted to flip the light back yellow for stocks because earnings for big tech start next week and they're probably going to be good. But for now, because of generally the valuation risk still in tech, keeping the red light on for the moment. Bitcoin might have to go green if it can get back to like 70K, but it could just be a fluke bounce today. Everything else seems good. Let's look at stocks. That's the most interesting market right now for sure. The macro stuff are bonds and the dollar holding the range lows. That's not that surprising. Yields coming back in a little bit on the yield curve, but then bonds selling off a tad, normalizing. I think that makes sense. Stocks are where the fun action and the story is right now. But firstly, technically for stocks, the S&P, as we did come down, we still didn't really get into this meaty area, which is about 54.50. So we had a good chunk of time there last month in June. We're kind of drifting in there. And the NASDAQ, which already hit the lows from the last month, it kind of makes sense to think that S&Ps gravitate in that direction if correlations are starting to come back together. So I think that's the technical case for some further negative drift in the S&P 500. But again, when we start getting numbers from Alphabet next week, Tesla, I mean, there's no reason to think the Tesla numbers are going to be particularly great, but Alphabet numbers should be pretty good, and they should be able to hype up the AI stuff. The problem is that the market's gotten so messed up. People tried to do this hard pivot that just didn't really make sense. Again, trying to go into not just economically sensitive stuff, but the names with the really high beta to the economy. Look at the way we had the Moonshot ETF. This is a chart that goes back to July 11th, so that's just last week's in CPI. We had this big pop in stuff that otherwise had been just a waste of a trade, basically, for the better part of the last couple of years. Companies that don't make money or pre-revenue in some cases. So the market suddenly went into like the junk over the last week in response to the inflation move, and that didn't make sense. And all that came back down here in the last 48 hours. That's why I'm saying a lot of this does make sense. When you're about to trigger the SOM rule for unemployment, why would you then be suddenly putting these big bets onto companies that really depend on the economy because they don't have much else going for them? They're experiments, basically. Some of the value trade might make some sense if the Fed's going to cut and provide some easing. That probably does provide some help to some of the regional banks, financials that we saw firm up. That's why the value trade, I think, is doing the best basically since inflation. It's the only factor in the group I got here that's actually up. Value stocks by 1%. So I think that does make some sense. The market is getting conviction around the Fed cutting, and it probably will in September, but it's because things have slowed down. That's why good data has been good and bad data has been bad. To see jobless claims tick up this week, that was bad as well, and I think that's why it weighed again on some of the cyclical stuff here. The market is mixed up. The most reliable fundamental stocks are still big tech, but investors tried to abandon them. That's not usually good when you're running away from your leaders, your generals. Next week will be fun. I'm sticking with what I got for now. We'll update it if we need to. Have a great weekend.